The Reserve Bank of Australia didn't consider a hike as it held rates yesterday. Aussie consumer confidence jumps to its highest since January 2023. And August inflation data today for Australia should show the temporary impact of cost of living support. That's coming up in our 5 Things in 5 minutes. And then in our bonus deep dive interview, ANZ Chief Economist for Greater China, Raymond Yeung, analyses yesterday's China stimulus package and explains why it could have been bigger.
I'm not saying this support has no impact at all, but this is certainly not big enough.
But first, in 5 and 5 with ANZ, the S&P 500 rose slightly overnight to a fresh record high, with companies exposed to China getting a boost after authorities there launched a stimulus package. More on that in our deep dive. Meanwhile, the US dollar index was down 0.3% at 4 a.m. Sydney-Melbourne time, as weaker US consumer confidence led traders to price in about 75 basis points more of cuts by the Fed at 2 more meetings in 2024. So that suggests a 50 basis point cut at either one of those 2 meetings. In contrast, the Reserve Bank of Australia yesterday held its cash rate at 4.35% against a backdrop of global rate cuts. But while the RBA board noted upside risks and still wouldn't rule any options out, ANZ head of Australian economics Adam Boyton says the tightening bias seen in August was not as strong in September.
For the past few months, the Reserve Bank has been, whistling to a slightly different tune to other central banks. What we did get, though, that was interesting and suggests that the tightening bias has been watered down some is that in the press conference, the governor noted the board did not explicitly consider a rate hike at this meeting. So that is a shift from where we were in August, where a hike or no change were both explicitly discussed.
At 4 a.m. Sydney-Melbourne time, the Aussie dollar was trading up 0.58% at 68.77 US cents, while the Kiwi was up more than 1% at 63.28 US cents. That's the highest since December last year. Number 2. Adam says ANZ Research continues to expect the RBA will commence rate cuts from February next year.
The momentum in the labour market at the moment would tend to suggest that the risks around that might be currently skewed toward a later start, but we also know from history the labour market can sometimes turn quickly. So we are sticking with the February call. I guess the point the Reserve Bank was making yesterday is certainly they're not going to be in any hurry to cut rates, so it is very difficult to see interest rates falling this year.
Number 3. Attention in Australia today turns to the August partial inflation indicators. ANZ senior economist Catherine Birch is expecting a fall in the annualised rate from 3.5% in July to 2.7%. That's the first time partial inflation would be inside the RBA's 2 to 3% target band since October 2021.
That fall is likely to be driven by a double-digit drop in electricity prices in August, following the 6.4% decline that we saw in the previous month. Really reflective of the government rebates for households on their electricity bills that are continuing to roll out. So in July, we saw the rebates introduced in Queensland, WA and Tasmania, whereas in August, we'll start to see the rebates introduced in New South Wales, Victoria and South Australia. And these states account for around 78% of electricity in the CPI basket.
Number 4. Adam says the RBA board made a point yesterday that while headline inflation will decline for a time, it was focused on underlying inflation, which remains too high.
They restated the most recent projections in the August statement on monetary policy show that it will be some time yet before inflation is sustainably in the target range. So the Reserve Bank won't be, for want of a better phrase, high-fiving later today if we do get that circa 2.7% headline inflation print that we in the market are expecting. They will be waiting to see signs in the quarterly inflation data that we don't get until the end of October, that core inflation, trimmed mean inflation, is looking more sustainably consistent with the target band.
Number 5. The RBA warned the jobs market remains tight despite some easing and that household consumption is expected to pick up. That comes as ANZ Roy Morgan's consumer confidence last week hit its highest level since January 2023. Here's Catherine.
Now, that might be related to last week's stronger than expected labour market data, which showed that employment had increased by more than 143,000 workers over the past 3 months and showed that participation is still sitting at a record high. So this positive result may be easing some households' fear of job losses, so boosting their confidence in the economic outlook.
Catherine Birch there. Now, in our bonus deep dive interview, ANZ Chief Economist for Greater China, Raymond Yeung, spoke to my colleague Alex Tarrant about why China's stimulus package announced yesterday could have included more.
Basically, they have announced to cut the RRR, the reserve requirement ratio, by 50 basis points and inject 1 trillion through this RRR cut to the banking system. That's a 1 trillion renminbi. At the same time, they also lower the policy interest rate by 20 basis points. This is a bit higher beyond the market expectation because the market used to be seeing a 10 basis point cut, but now this time around they're willing to cut by 20 basis points. And also many other monetary policy easing measures, including mortgage rate cut by roughly on average 50 basis point cut, and also some stock market supportive measures, including the central banks willing to open the door for a security brokerage house to tap their funding, so on and so forth. So there is a slew of monetary policy and financial support to both the stock market, the property market, and also bank liquidity support in today's announcement.
You don't seem to think this is big enough, though. I mean, tell us why that is.
Well, look, roughly, if we include this 1 trillion RMB injection plus other financial support, a couple hundred billions for each, and altogether, we just talk about roughly 2 trillion RMB support to an economy of roughly 130 trillion RMB now. So it's a small amount of injection. I'm not saying this support has no impact at all, but this is certainly not big enough. If we consider what happened in 2009 during the GFC, and such an announcement, first of all, will be announced jointly by different ministries, not just by the central bank and financial regulators. And we don't see Ministry of Finance today, we don't see the NDRC, and we don't see the announcement led by the Premier himself. It's only an announcement by the monetary authorities and financial regulators. So I think overall, in the scale of 4 trillion package in 2009, that was roughly 11% of the GDP of that year. If we want to repeat what happened in 2009, in today's scale, that should have been 14 trillion injection. But today's announcement is only roughly just 2 trillion package. So certainly not enough.
Do you think this could be like the start of a rolling wall of announcements, though? Or do you think they're putting their hopes on this?
Well, one of the positives, though, I saw today's announcement is the central banks saying that they are willing to ease more, and they're willing to cut the reserve requirement ratio by maybe 25 or 50 basis points. And also I want to exclude another interest rate cut going forward. Obviously, we not talk about another cut next month by the end of this year, but they certainly will have more room to cut in the next quarter, given the fact that the US started the easing cycle as well, and that's relax the exchange rate constraint, that if they want to stabilize the renminbi exchange rate, then now is a good window for Chinese central bank to ease more. So I think that even after today's announcement, there might also be some other ministry doing the same, even though they're not doing that jointly. It's not as powerful as the one in 2009, but at least they are willing to ease more, and that's also show the determination for the leadership to secure or at least to attain the official growth target of around 5%. I'm not talking about exactly 5%. That's not the policy wording. So we are still confident in our GDP forecast for this year, 4.9%. I think that is still achievable because of today's package.
Raymond Yeung there talking with my colleague Alex Tarrant. That was 5 and 5 with ANZ for Wednesday, September the 25th. Catch you tomorrow with a review of Australian inflation data and further analysis of that China stimulus package. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.